Welcome back to the second presentation for our first section, where we will take a look at the overview of investment alternatives. Now, did you study the first section? Did you go back over and listen to it, review it again? Good. Because now we're going to fly in a little closer. We're still way above the investment landscape, flying at 30,000 feet, but we're coming down a little closer, and we're going to take a look at the alternatives that are available to us in more detail. You ready? Okay, but first we talk about return, investment return, and investment risk. It turns out that investment return is relatively straightforward to measure. How much did you start with? How much did you end with? That's your investment return. How long did it take you to get what you returned? And there are two returns we need to concern ourselves with: total dollar return and total percent return. The total dollar return is the return on an investment measured in the dollars that account for all cash flows and capital gains or capital losses. But more important to us is the percentage return. Well, the dollar return is pretty important, but the percentage return is more important because it allows us to compare investment alternatives. The total percentage return is the return on investment measured as a percentage of how much we've invested. That accounts for all cash flows, all capital gains or losses. So we can compare this one that's returning over the long term 7-8% to something that's returning 3 or 4%. Now, how do you measure risk? It's not easy. There is no perfect measure. How do you measure something that can go wrong? It's not easy. And although there are many measures, all of them are imperfect. The one popular measure that we will spend the most time on is standard deviation. This measures the volatility of an investment. Volatility? Yeah, that's the industry's euphemism for I lost a lot of money. In any given year, there is about a 2/3 chance that the return on an investment will be within one standard deviation of the historical average return. Huh? What? Sounds like statistics, right? It is, and we'll discuss it in detail later on. But relax, you do not have to do any statistics calculations in this course. All right? All you have to know is that the higher the standard deviation, the more volatile the investment, the greater the variance from the norm. Somebody else is going to do the standard deviation calculation for you. You just go online and look it up. That's all you have to do. It's already done for you. And we will investigate it later in the next presentation. So you see, we always have to keep in mind investment return and investment risk. Trying to look at one without the other can lead us down a very dangerous path. Slide number 17. Here they are, folks. Here are the major investment alternatives. Equities, also known as stocks, common stocks. I know it's a terrible name, common stocks, but it has to do with the fact that the shareholders are shareholders in common, not because they're plain ordinary common. Fixed income securities, bonds, also called debt securities, debt instruments. Short-term investments, also known as cash. Right, you need your money soon, you need it in cash. Mutual funds, also known as investment companies. Great name, investment companies. And then hybrid securities, preferred stocks, convertible stocks. We will deal with them a little bit in this course later on. And as we said in the first presentation, we'll spend a little bit of time on real estate and physical assets, commodities, collectibles. Now, this last one on slide 17, as we said, is not always considered an investment. I certainly don't consider them investments. But what you need to know is that there are such things known as derivatives that derive their value from other assets. And the major examples are options and futures. So let us now take a look at each in more detail. Slide 18, equities, stocks, common stocks. What are stocks? Well, we are told when you're a broker, when you're a stockbroker, registered representative, don't even use the word stock. No. Use the word business or corporation. You're investing in a business. And when you buy 1 share or 10 shares or 100 shares, you are becoming part owner of the enterprise. Stocks represent ownership. Sound like a test question? All right. Great. I own a piece of a business. FedEx, I own 1 share of FedEx, and I see a FedEx truck driving down the street, and the one hubcap is mine. Great. On that one truck. Why? Why bother owning a share of a company? Well, there are some very real rewards, investment returns. Investors receive dividends, which are optional payments to shareholders. They are not mandatory. A company does not have to pay dividends. Some have never paid dividends. Some have been paying dividends for over 100 years. And if the company does well, the stock should do well, and we should be rewarded with capital gains. If the company doesn't do well, right, exactly. And one thing that we do not discuss often, but is there, is the idea of limited liability. And if you've taken BUS123, Introduction to Business, you know what I'm talking about. There are different types of business, sole proprietorships, partnerships, corporations. When you have a business, which is a sole proprietorship, you and the business are one. So if the business incurs any debts, they can come after you. In a corporation, when you invest in stocks invest in corporations via stocks, you are a limited liability owner. So if the corporation goes belly up, even if it has tremendous debts, you're shielded. Now, there are situations where the corporate veil, as it's called, is pierced, and they can come after the shareholders, but it's very, very rare, and it has nothing to do with the major companies that we're going to discuss in this class. That's just very rare. So, are either of these things, dividends or capital gains, mandatory? No. So what we say is that stocks are risky. They are volatile, which is a euphemism for I lost a whole lot of money. If you go up to somebody and you say, how's that stock that you bought last year? How's it doing? Well, it's been pretty volatile. It means they bought it for $12 and it's selling for 30 cents. Do you know anybody who's done that? I do. I've known him all my life. He's a kind of a friendly, kind of goofy kind of guy, teaches fine. Yeah, it was a great company, folks. It was, yeah, right. but, over the long term, stocks have given us the best returns over time. 8 to 10 to 12%. Some have done more, some have done a whole lot less. What I normally tell people is 8, 9, 10%. Okay, don't want to get their expectations too high, even though some stocks have done a whole lot better than 12%. And stocks should be considered a long-term investment. You are buying this company and you are going to share in its success over the long term. But let's take a look at the 2008 definition. Stocks are equity investment instruments designed to lose value. Yeah, 2008 was like a bolt of lightning, folks. It was a lot different than 2000 to 2002, where stocks lost about 50%, but it took them 2.5 years to do so. In 2008, they just plummeted. And oh boy, was it a sick feeling. But if you hung on, did not jump ship, in fact, if you continued to invest through 2008, 9, 10, 11, even though everybody was scared to death, you did pretty darn well. Slide number 19, bonds. Fixed income securities. Why do we call them fixed? Because we know how much we're going to get. Yeah, unlike stocks where we really don't know. In the case of bonds, assuming nothing goes belly up, which normally it doesn't, you know how much money you're going to receive. And that's why we call them fixed. Fixed income securities, bonds, debt. See, they're long-term loans. You're lending your money to a corporation, to a state or local government, the city of Chula Vista, the state of California, the Southwestern Community College. You can buy bonds that are paid by Southwestern Community College. And then the granddaddy of them all is the federal government, Treasury bonds. People think that the Treasury, when they need money, just prints it. No, that's not what they do. They borrow it. They issue bonds, and they tell investors all around the world that we will pay you such and such percent for 10 years or 20 years or 30 years. And then at the end of that time, we'll pay you back your money. And that's a bond. Bond investors lend their money to the bond issuers. See, you're playing the part of the bank. You tend to think of loans as liabilities because we go to the bank, we get a loan, and the bank gives us the money, and we have to pay it back with interest. But when you invest in bonds, you're playing the part of the bank. The bond investors receive interest and a promise that the loan will be repaid when due. And typically, most people pay their car loans, their mortgages, their credit card loans. And the same thing is true of corporations and municipalities and the Treasury. Treasury has always paid its debts. Most of them repay their debts. So you know how much you're going to get. So historically, they've been much less riskier than stocks, where you don't know if they're going to continue to pay dividends. You don't know if the company's going to do well and have capital gains. So what do you expect? Less risk? You got it. Less reward. Now, over the long term, bonds have paid 4 to 8%. 4, 5, 6% for government and muni bonds. 6, 7, 8% for corporate bonds. Now, right now, they're paying less than that. But they'll revert to the mean, so to speak. They will go back up over the next few years, hopefully, as the economy improves. They have been, over the long term, good intermediate term, and for many people, good long-term investments. But let's see the 2008 definition. Bonds are fixed-rate investment instruments designed to lose value. Right. In 2008, what happened? Well, except for Treasury bonds, everybody in the world was sure that the world was going to end. So not only did they dump stocks, they also sold their bonds. Later. We'll discuss this later. Which meant the price dropped. So corporate bonds and municipal bonds fell in value. And we'll discuss this later on. When they fall in price, the interest rate goes up. Bond prices go down, interest rates go up. Interest rates go up, bond prices go down. It's an inverse relationship, which we'll talk about later on. Don't worry about it. All you have to understand is on here. Now, on this slide. Now, did the bonds come back? Yes, they did. Did they fall as much as the stocks? No, they didn't. They fell, but not as much as the stocks. You starting to understand, right? You're going to get less return. You're also going to deal with less risk. You want more return? You're going to have to handle more risk. Slide number 20. Now, short-term investments, cash investments, short-term vehicles. This is where we put money that we need in 6 months or a year, because there's always a probability that the stock market could lose 20% in a month or a week or a day. It's done it before. It'll do it again. And when we say short term, we normally are talking about a year, but it could be longer depending on your situation. You need to buy a house and you have money for a down payment. Depending on it, might be 1 or 2 or even up to 3. 3 years, I don't know. But usually when you put your money into short-term instruments, it is guaranteed by the federal government or an agency of the feds, or pretty darn close. They are extremely liquid, which means you can usually just transfer the money into your checking account, or some of them will let you write a check. But now with all these electronic transfers, you don't even need that. You just go online and transfer the money into your checking account. Very low risk, some would say no risk, of losing your principal. So what? Yeah, exactly. You're starting to understand, right? No risk or very low risk, very low return. And historically, these have paid 2, 4, 5%, 2, 3, 4. What are they paying now? Nothing. Far less than 0%. In fact, I have a cute little document that I grabbed. My wife got a solicitation for a high yield savings account paying 0.9%. And I thought, this is too good to be true. I scanned it and put it on the website. We call short-term investments a place to park your money. You're ready to put money into the market, or you need to buy a car, or you need to buy a house or whatever, or you need this money for education. It's your loan, not your loan, or your loan or your federal aid or your financial aid, and you don't want to put it in the stock market because you could lose 20% right away. So you park your money in one of these short-term instruments. We also use this for an emergency fund, and we'll discuss the emergency fund at the very end of this chapter, in the very last 4th presentation. Now let's see the 2008 definition, because 2008 comes around every 20, 30, 50 years. Short-term investments are instruments designed to accept what remains of investors' money after they have given up on stocks and bonds. This is what happens, folks. We're not rational individuals. When the market falls 20, 30, 50%, we panic and take our money out of stocks and bonds and put it into short-term cash investments. It's one of the worst investment decisions to make, but it is so typical that people do it. They sell at the bottom because we're not rational individuals. We're emotional individuals. And we are so terrified that there's going to be a crash after there's been a crash that we bail at the very worst time. That's the time when you should be putting money into the market, right? Unless you believe that the world is going to end, in which case it doesn't really matter. Slide number 21. Let's take a look at some examples. And as we said, we will discuss these in detail in the 4th presentation of our first section here. Deposit accounts, savings accounts, share accounts. They're called the savings accounts like credit unions, but their legal term is share accounts. Series EE or I savings bonds, treasury bills, not treasury bonds, but treasury bills. CDs, certificates of deposit, money market accounts, money market mutual funds, commercial paper, what a silly name, bankers acceptance notes. What are these things? Well, later. We'll discuss these later in detail. Slide number 22. I've read the chapter 4 in the upper. In the upper part of the slides, you'll see I'm putting the chapters where we discuss these things. And I read that as opposed to the slide. My apologies. Slide number 22. Mutual funds. mutual fund. Well, yeah, you can't possibly live in our culture and not hear about these things over and over again. They advertise them, and if you have a 401k at work, they're telling you how wonderful they are. Well, I like the legal term, investment companies. You're not going to hear that term unless you're in the industry. You're not going to hear people use the term investment companies, but I like it a whole lot better because it's much more descriptive of what they are as opposed to a mutual fund. Mutual funds, investment companies, are companies that pool investors' money and invest in a diversified portfolio of securities. Well, think about it, folks. We have limited funds, those of us in the workaday world. Can we really buy 20 different stocks or 20 different bonds? It's difficult for us. It's not impossible, but it's just difficult. When you buy a mutual fund, you get instant diversification because the mutual fund can purchase 200 or 300 stocks or bonds. And these people are professional money managers. Some of them are very good. Some of them are so-so, and some of them are not so great. They are very popular forms of investments. Why? We're going to see why. Because of the ease of use, the ease of dealing with the mutual fund company, and because of 401ks and other employer-sponsored retirement plans. Yeah, exactly. They range from very low-risk investments to extremely speculative. And when we deal with mutual funds in Chapter 4, which is our next chapter, by the way, we will show you the full range of mutual fund choices. And we won't show you all the choices. We can't. It's impossible because there are literally thousands of choices. But you're going to see the range of options, and you're going to see that the industry is huge. Now let's take a look at the 2008 definition. Yeah, them too. Right? Unless you happen to be in a money market or a treasury bond fund, your mutual funds got hammered in 2008. There was no place to hide. Yeah, it was just one of those times that come along every 20, 30, 50 years and scare the living daylights out of investors. And people swear off stocks or bonds or mutual funds for 4 or 5 years until the market jumps another 100%, which it's done in the last 5 years. And then they get in, and when you'll see. Now, here is slide 23. If you're listening to this, I apologize, but you can't see it. But I do hope you will take a look at it, and we'll come back to it again in Chapter 4. I made this graphic. Aren't you proud of me? I'm not very artistic. My brother got those genes. I'm good at making stick figures, though. Aren't those great stick figures? Let's get the magic cursor in here. Here we are, folks. We're the little people. And more of them are women because women are realizing, especially the millennials, that men, they say they'll take care of them, and they saw what happened to Grandma. Grandma listened to Grandpa, and who said he'd take care of her, and he didn't know what he was doing, and then he died, leaving her penniless. So the women are saying, I'm taking care of my own finances, and we give our $50, $100 a month to the people in the top hats. And more of them are women, thankfully, because it's already been shown statistically that women are better investors. Take that, guys. I know it's hard to swallow, but it's already been shown. Now, why is that? Well, there are some reasons that are posited. Did I say that right? That are theorized, some theories. Women are more conservative. Women are not likely to look at it as a football game or a baseball game where they're trying to hit the home run or throw the Hail Mary pass. Women are more interested in singles. whatever analogies you want to use. But it turns out that women make better investors. And so more and more women are in the industry. And what they are doing is they're taking a pool of money, because there are millions of us little folks, and we are putting our money into these mutual funds. Now, I know it looks like a potato, but it's supposed to look like a little pond. And those ponds, those pools, those funds are billions of dollars, because there are millions of people putting billions of dollars into these things. And so what the investment managers do, the people in the top hats, is they buy stocks. Now, they don't buy 5, they don't buy 10, they buy 200 stocks. It's called a stock mutual fund. If they buy bonds, it's called a bond mutual fund. And again, they buy 200 or 300 bonds. If they buy the short-term cash instruments that we discussed, then it's called a money market mutual fund. But what happens often is the mutual fund disappears and people just call it a money market. Have you got your money in the stock market? No, I got it in a money market. I'm sitting on the sidelines. I'm sitting in cash. I'm parking my money. And then what we see here is just the beginning of the explosion of different types of mutual funds. You see this balanced mutual fund? It's a mutual fund that invests in stocks and bonds. Very good choice for some people. A balanced mutual fund. And we will spend a couple of weeks, folks, after we're done the first section, just dealing in mutual funds, because they're so important for many of us, especially people who have 401ks, or if you're a government worker, the thrift savings plan that we'll discuss later on. Yeah. Approximately 50% of American households own mutual funds, or used to. Yeah, it's gone down a little bit. People have decided that they don't want to invest in mutual funds. Well, just a few, but I mean a few percentage points, but that's a lot of people. And of course, they'll wait until the market goes up 100% and 200%. Then they'll jump back in just in time for the next crash. Slide number 24, hybrid investments. This is all you need to know about hybrids, folks. Slide 24, we will discuss these after we've gone through stock, mutual funds and stocks and bonds. We will discuss these later on. They don't represent a very large percentage of the investment universe. They're not that important for most of us. Hybrid investments were designed to offer the stability of fixed income investments, bonds, with the opportunity for capital growth of equity investment stocks. They were supposed to have the best of both worlds. Well, folks, nothing's perfect. If you want the best of both worlds, you can want the advantages of each. What's going to happen? Right, you're going to get the disadvantages of each. So these things can be profitable for individual investors, but my advice and what I've seen, the experience, is most people just don't bother with these things. There are 2 examples that we'll discuss later on in the semester: preferred stock and convertible securities. Preferred stock. Now, doesn't that sound like something you want preferred as opposed to common stock? Well, it turns out, no, you really don't want preferred stock. There's a reason. There are reasons for that we'll discuss later on. They represent ownership in corporation, but unlike common stocks, dividends are not considered optional. Now, they are legally optional. You don't have to pay dividends because they are stocks. They're ownership. But when you buy a preferred stock, you are often buying it for the dividend, and the company understands that you're buying the preferred stock for the dividend, so they tend to pay those dividends no matter what. Unless, of course, the company's in serious trouble, and then they can't pay the dividends. And convertible securities, now don't they sound exciting? Convertible, kind of like a convertible car. Ooh, boy, you're going to top down driving sunshine. Yeah, until you realize that this thing is a real pain. My understanding is they've gotten better in convertible cars. Well, convertible securities are the same idea. They sound real sexy and exciting, but they don't really live up to their expectations. They are bonds or preferred stock that can be converted into common stock. So if the company does really, really well, you can take your bond, you can take your preferred stock and convert it into common stock. So that's all you need to know. You don't have to know anything more. I don't care what they say in Chapter 3. This is all you need to know. And as I'm not sure, but I think on the exam I'm going to make this optional. So it'll be a bonus question. Hybrid instruments, hybrid investments are designed to offer the stability of fixed income investments, bonds, with the opportunity for capital growth of equity investments, stocks. The best of both worlds and the worst of both worlds. Exactly. And you will notice what I've noticed is some people will just lump them both in with stocks or lump them both in with bonds. I was so taken aback when this one long-time stockbroker, very, very seasoned stockbroker, when I talked about preferred stock, he just, they're bonds. And I looked at him and they're bonds? He goes, they're bonds. Stay away from them. They're boring. And I'm thinking, is he right? Are they really bonds? No, he's not right. They're not bonds. They are stocks. But he just lumped them in with bonds and just wanted nothing to do with them. Why? Because they have the disadvantages that bonds have. They're boring. They're not too exciting. You can't get rich with them. So you understand? You're going to hear people lump them into two different worlds. So be careful. Slide 25. Other popular investment vehicles. Real estate, residential, commercial, raw land, real estate investment trusts, which are actually look like stocks. Tangible assets such as precious metals, jewels, art, and collectibles. And then tax advantage investments such as limited partnerships for oil and gas or cattle or low-income housing projects. If there is sufficient time and interest, we will look at some or all of these, especially real estate and tangible assets. I have something, I believe, to offer with regard to real estate. I'm not the best real estate investor, but we've been, my wife and I should say, fairly successful with real estate, so I have something to offer. By the way, none of these were spared in 2008. In fact, real estate was the hardest hit in 2008. People would talk to me and say, well, aren't you upset about losing 50% on your stocks? I said, well, I'm not happy about it. Certainly no. It's like a punch in the gut. But the real estate investors were destroyed, especially the people who jumped in 2005 and 6 and early 2007, right before the organic matter hit the ventilating device. They lost everything they had. Was just taken away from them when the prices of houses dropped 50%. I mean, that just very rarely happens, that real estate will be hit that hard, and yet it did. I had an ongoing discussion with a friend of mine who I thought he was a little over the top. I thought real estate, we both agreed that it was a bubble. We both agreed that the real estate was in a bubble. And I thought it's going to drop about 20-25%. He said, no, 50% or more. He was absolutely right. But he made bets against the real estate market too soon in 2005 and 6 as it was still skyrocketing, and he lost a lot of money. So be careful. Slide 26, derivative assets. Now notice I put a bunch of question marks up there. Exactly. These are speculative securities, right? We don't categorize speculations as investments, at least in my humble opinion. You're going to hear different from other individuals. They derive their value from an underlying security or asset. How does that work? Relax. We'll deal with it at the end of the semester. All you have to know is that line. They derive their value from an underlying security or asset. And there are two major examples. There are many, many others. Options also, the real term is options contracts, but that's hard to say, so people just say options, calls and puts. And chapter 3 tries to describe these things in detail and just confuses the heck out of people. And then futures, which are really called futures contracts, but that's hard to say, so people just say futures. And this is where we hear people talk about pork bellies and oil contracts. Those are futures on commodities. And there are futures on financial investments, as we will see later on. Many in the financial world, much later on, many in the financial world, myself included, do not categorize these as investments. Because if we go back to the very beginning of our chapter here, where we discussed what an investment is, a reasonable expectation of investment income and or capital growth over the long term, and these things offer neither of that. They don't offer income, and you don't get a whole lot of time to deal with them. They disappear after 3 months or 6 months. The derivative speculators did not feel so all alone in 2008. Usually, they're the only ones who are proud to have only lost 30%. So they looked around and saw the stock investors lost 50%, the bond investors lost 20%, the real estate investors lost 100%, and then some. And they said, gee, we're doing all right. We only lost 30%. Because that's what they do every year. They lose at 30. Well, they'll tell you about the time that they made 200% in 3 days. They won't tell you about the time where they lost 100% in 1 day. Okay, slide 27. So what are we going to emphasize in this course? Okay, students, what are we going to deal with? Well, we will spend the vast majority of time dealing with these four. In fact, the third one we'll only spend really a little bit of time on. Stocks. We're going to spend 4, 5, maybe even 6 weeks on stocks. Why? Because that's where the action is. That's how we can get rich slowly over time, is with stocks. Prudent investments in high quality companies. And we are owners. We will spend a couple to maybe 3 weeks on bonds. Why? Because they're important. Especially as you get older, you need that stability where you are a loaner and you know how much money you're going to receive. We'll just spend one presentation on short-term investments, short-term securities. Why? Because they're relatively straightforward, and we only need them for the times where we cannot lose money. An emergency fund or a house, or a down payment for a house, or education, or a car, because our principal is safe, often guaranteed, or pretty darn close. And then we'll spend a couple of weeks, as we said, right after the first section, on mutual funds, investment companies, where your investments are managed on your behalf. For the vast majority of investors, these are the most popular and most important financial investment options. Now, folks, does that mean you shouldn't get involved in real estate? I'm not saying that. But this class devotes itself mostly to financial investments. We'll discuss real estate at the end of the semester, and if you are so inclined, we have classes just in real estate. I mean, that's a whole world into itself. And I know some of you are waiting to talk about gold, aren't you? Yeah, we'll excoriate gold soon enough. Relax. Slide now 28. In the face-to-face class, I give out these A, B, C, D cards, and it's meant to check for comprehension. Okay, there's an old saying in the army, in the military, when you're teaching the cadets, you tell them what you're going to tell them, you tell them, and you tell them what you told them. So I told you what I was going to tell you. I told you, and now I'm asking you, what did I tell you? Did you get it? And so you, in the face-to-face class, would raise your A, B, C, D. And if you printed out these things, if you printed out the slides, and if you do print them out, I suggest you print out 4 or 3 6 is okay. 9 is too many. You can't read the darn things. Well, maybe you can if you got good eyes. But don't print out one to a slide because you'll waste a whole lot of paper. If you printed it out, you already know the answers. So the investment companies. What are investment companies that pool investors' money and invest in a diversified portfolio of securities? Investors get diversification and professional money management. What are these types of investments? Are they short-term securities, common stocks, bonds, or mutual funds? You know the answer. Right, they're mutual funds. You hear the term investment company from somebody who works in the industry, you know they are talking about a mutual fund company. Now, it turns out that there are other types of investment companies other than mutual funds, but mutual funds are the biggest group of investment companies. And what do we get? Diversification and professional money management. That's our big reward, our big advantage of mutual funds. And it turns out they're just very, very easy things to invest in. What are investments that represent ownership in a corporation? Investors receive dividends optionally and capital gains optionally, or they might receive capital losses. Are they hybrid securities, common stocks, bonds, or short-term securities? Right. Ownership, you know, those are common stocks. When people use the term stocks, they are almost always talking about common stocks. Unless they say preferred, they really mean common stocks. And I know it's a terrible term, but it has to do with the fact that shareholders are shareholders in common. Every share gets one vote if there's a decision to be made. And we'll discuss this later when we get to stocks. What are investments, slide 30, with very little risk and correspondingly very little return? Often used as a place to park your money or for an emergency fund of 3 to 6 months income. Low risk, low return, hybrid securities, common stocks, bonds, short-term securities. Right, short-term securities. You need this money in 6 months? Don't put it in the stock market. Right, you need it in a bank or a credit union or a money market mutual fund. Slide number 31. What are fixed income securities that represent loans, debt, to corporations or municipalities, state and local governments and agencies, the federal government? Investors receive interest and a promise to repay the loan, and that interest and that promise is mandatory. Are they hybrid securities, common stocks, bonds, or short-term investments? Right, these are bonds. Bonds are fixed. You know how much interest you're going to get. You know you're going to get your principal back, unless the company goes belly up, which is, it happens, but it's very rare. Slide number 32. What are securities designed to offer the stability of fixed income investments with the opportunity for capital growth of equity investments? Examples include preferred stock and convertible securities. So we're looking for stability, which we get from fixed income investments, and we're also looking for the capital growth that we get from equities. And what are these things? Are they derivatives, common stocks, bonds, or hybrid securities? These are hybrids, right? A mixture. The best and the worst of both worlds. The advantages of both and the disadvantages of both. And lastly, what are speculative securities that derive their value from an underlying security or asset? Examples include options contracts and futures contracts, or just options and futures. Derive their right. Hey, you already know it's not secure hybrid or bonds or short-term securities. It is derivatives. You can make a lot of money very quickly. More likely, you can and will lose a lot of money overnight. So are these things investments? Well, it depends on who you talk to. I don't categorize them as investments. We use the term speculation, meaning gambling. And our last slide is not really an A, B, C, D, or E slide. What we're asking you is what are reasonable long-term expectations of returns from the following investments. And the reason you need to know this, folks, is because you're going to be the expert in your family, among your friends, in your coworkers. They're going to turn to you and ask you, well, what can I receive from stocks over the long term? And what are you going to tell them? What are you going to tell them? 8, 9, 10%? Knowing full well, because you've taken Business 123, that some have done a whole lot better, 11 or 12%. And we're going to see some that have done 11 or 12%. But tell people 8, 9, 10%. But also mention the volatility, which we'll deal with later on. How about bonds? How are we going to do? What are you going to tell people if they ask you what can we get from bonds? Well, during normal times, 4, 5, 6% for government bonds, municipal bonds, 6, 7, 8% for corporate bonds. But are these normal times? No. Bond yields are lower. They're on the low end of much lower than this 4 to 8%. Some are paying 2.5%, 3%. How about short-term securities? What can we get from them? Over the long term, they've paid us 2 to 5%. Right now, what are they paying? Right, a whole lot less than 2%. Some of them are paying 0.2%. And what about mutual funds? Well, you don't know. It depends on which mutual fund you invest in. If you invest in a stock mutual fund, well, then you expect to get 8, 9, 10% over the long term. If you invest in a bond mutual fund, 4, 5, 6%, maybe 7 or 8, depending on the bond fund. What about hybrid securities? Again, you don't really know. It depends, depending on the investments. And you might do very well. You probably won't. These things don't tend to live up to their expectations. So, they look more like bonds than they do anything else. And then derivatives, minus something. You're going to lose. I don't know how much you're going to lose, but you're probably going to lose. So, what did you think of our overview of investment alternatives? Has it cleared up many of the misconceptions and the misinformation or the partial information that you've gathered over the years from listening to people who supposedly, maybe they do know what they're talking about, maybe they don't? Yes, I find that there's far too much hype about investment alternatives. It's actually very straightforward when you look at it from the 30,000 feet level, where we are. We're still flying over the investment landscape. When you get down into the trenches, oh boy, doesn't it get complicated and more difficult. But we're not there yet. We're still looking at the landscape from above. And we find that things are a whole lot more simpler than people make them out to be. Okay? Now, you're going to go back over it and look at it again and again and again, because you need to know these things cold, so to speak. You need to know them. So that if I called you up at 2 o'clock in the morning and said, what can we expect from bonds over the long term? What kind of investment returns? You're going to say, 4, 5, 6%, maybe 6, 7, 8% for higher for corporate bonds. I'm not going to call you up at 2 o'clock. Relax, I'm not going to do that. But you really need to know this. Okay? All right. So, great, folks. In our next presentation, we're going to discuss risk versus return in great detail. And many would say, or I would say, that is the entire course in a nutshell. So go back over this information, make sure you have it memorized and can burp it back right away, and then see you in the next presentation where we discuss the eternal tug of war between investment return and investment risk. Do you want to eat well, or do you want to sleep well? See ya!